Welcome to Trends with Benefits, an award-winning podcast by Van Eck with a forward-looking perspective. We explore new ways of thinking about the markets, work, and life. Here's your host, Ed Lopez.
So today we're going to be talking about private investments. And, I guess for the audience, let me introduce you. I'm speaking with Matt Malone. He's president and head of investment management at Opto Investments. And, we wanted to talk about, like I said, private investments. I think by one metric that I saw, it's something like an $11 trillion marketplace, according to Preqin, I believe. And I think they're expecting it to be almost double that by 2027. But that might just be, I think, private equity and private debt that survey was looking at. What do you guys benchmark the whole space at?
Well, that's the thing about private investments is everyone defines the market a little differently. And by the nature of them being private, it's a little bit hard to tell exactly what the total size is, right? So it's a different one. I think those numbers are in the right ballpark in terms of private investments. But I think the thing to be focused on is the growth, and particularly the growth in the allocation to privates by the mass affluent, high net worth client, which is where we're active as a company, but also where I've spent my career. So it's a big space. I mean, if you look at, there's a recent report that came out that said, and this is worldwide, right? So this is out of the about 300 trillion of assets worldwide. Individual investors hold about 50% of that, and only 16% of that is in alternative investment funds, which is much lower than the institutional allocation, which is something for those of us who have been in the space for a long time, you hear a lot about, which is institutions historically have allocated a lot more to private investments because they've had more access, and individuals have not. So I think where the market's going to see that growth in terms of allocation is really from the non-institutional investor going forward.
Yeah, and that's what I've been hearing a lot more about. Definitely over the last decade or so, more interest in privates, and then I think more recently perhaps like private debt. And then I think there are things underway to help influence or encourage more individual investor participation, which I think is fascinating. I don't know. What do you think are some of the driving forces behind the growth that we've seen in this market, and what you think will influence the future of it?
Yeah, well, I think more broadly speaking, when investors are thinking about their portfolios and meeting their goals, we've all, I think, grown up on modern portfolio theory these days and diversification. And what we've seen, historically, the diversification has been done through traditional stock and bond portfolio. The 60-40 is kind of the benchmark for the traditional portfolio. What we've seen in recent years is, stocks and bonds have really recorrelated, and the 60-40 has really not delivered the return profile that investors were expecting. In this rising interest rate environment, we've seen both stocks and bonds fall. The 60-40 was down 17% in 2022, with both the stock and bond piece falling effectively very similar amounts, right? 19% in the S&P, 13% in the ag. That allocation hasn't worked for folks in this time of volatility. And that's why we've seen institutions move more and more into private markets. We're going to continue to see individuals move there, right? So I think that's a big driver is folks want more exposure to these asset classes. I think also other traditional hedges failed recently. I mean, gold was basically flat in 2022. Bitcoin, while not a traditional hedge, was pitched as a hedge, right? Bitcoin was way down too in an inflationary environment. So the other piece that you see people see people focusing on is really that fewer and fewer companies are going public. Companies are staying private for much longer periods of time. And so that means that, when investors are investing in the public equity markets, they're not getting exposure to a big part of the economy. And a lot of the innovation and growth that's happening is happening before companies become public. So right now, fewer than 15% of companies with over 100 million in revenue are publicly held. That's a pretty small amount for some companies that are generating some significant dollars.
Yeah, absolutely. To me, that's been one of the most fascinating facts in recent times, is that more companies are staying private longer, and when they finally go public, they're already at high valuations. But back to one of your earlier points, I love the idea of being able to access more investment opportunities, but I wonder, and I agree with you that over time the correlations, or more recently correlations have skyrocketed between different asset classes. But I wonder if because of the last decade, last 20 years of falling interest rates, things just got to an extreme level, extreme valuations in stocks, extreme, low interest rates in bonds, that right now we're living through some kind of transitory period where things will wash out. People are saying 60/40's back, bonds are back. Maybe are we going to be back at more normal relationships that give people a little bit more opportunity in public markets?
Yeah, I mean, look, I think you got to pick your spots in public markets. Still, I think there's still a lot of uncertainty, and of course, that trickles through to private markets, right? Private markets are not immune to the broader macroeconomic cycle. They're not immune to changes in interest rates, but they do provide some insulation, and they do provide less volatility, and they provide access to different sectors, right? That you might get from public markets. But I think when you're looking forward, and I think where folks should focus generally is not, most of us are long-term investors or should try to be long-term investors unless we have something that's preventing us from doing that, whether we have some immediate liquidity needs or otherwise. And so we should be thinking about broad long-term allocations. And so, we can try to be tactical and time the markets. And most of us, and even professional investors, as we've seen, it's very hard to consistently time the markets. So I think the best way to think about, investing and building a portfolio is having an allocation to both, public stocks, bonds, and then alternatives broadly. And then within alternatives, there's a lot of different sectors that we can think about. And that's where I think things are going. You talked about access. That has been a big story in the private markets and giving more investors just access. I think we've gotten to a point where now investors have some pretty good access. It's not to everything, but it's to a lot of pretty good stuff. The next phase in my mind is personalization, right? So rather than just access, rather than just, hey, I can finally get something in private credit or something in real estate, I want to access the parts of private credit or real estate or private equity or venture that align with my goals, that align with maybe my view of the world, my ethics, where I want to allocate capital. And I think that is going to be the next phase of evolution in how investors access private markets as people continue to be educated and understand more about how private markets work.
Give me the breadth of private markets. What are we talking about? You highlighted a couple of them, but in your mind and what Opto does, what are the different flavors of that are you participating in?
Sure. So there's a few terms that get thrown around. Maybe we can kind of, first there's alternatives. And then I think within alternatives is private markets. So, I look at alternatives broadly as you can have alternative strategies and alternative assets. Alternative strategies are often executed by hedge funds. They typically are trading liquid instruments, whether it's stocks or bonds or options. They're executing alternative strategies using leverage or shorting or doing other things, but they're executing those within the liquid markets. So that's kind of one bucket of alternatives. Then there's what I would call alternative assets or private assets. And so that is where the underlying assets that are being invested in are truly private assets. So we're talking about private companies. We're talking about private credit, which runs a huge gamut. Private credit is typically lending to companies by private entities, and the instruments that are being used to lend are private. They're not high yield bonds that are traded. They're not bank loans that are also sort of traded on the secondary market. They're private instruments that are generally held by one group or a small group. So then we have real estate, right, which is a huge asset class. Many of us own real estate, residential real estate, our homes. It's very hard to wake up tomorrow and trade out of my home. It works the same way with all the office buildings and malls and industrial properties. Those are generally private, illiquid assets. And then, infrastructure is another area that we look at. I think it's important to make that distinction. If you think about, take private credit, for example, this is a space that's really matured since the global financial crisis. And if you talk to any private credit manager, they're probably going to tell you a very similar story, which is we had the global financial crisis. The global financial crisis as we all know, was sort of precipitated by significant leverage in the system, primarily in the real estate part of the system. But there was a lot of highly levered entities in the system that were taking a lot of risk. And there were regulations put in place that forced the banks to basically take less risk. And what that did is that provided the impetus for non-bank lenders to fill those needs. And that's where the private credit market has really boomed. If you look at where private credit market was, probably, maybe 200 billion back then, and it's at, over a trillion, 1.2 trillion, maybe more now. So something like a 6x in growth. That's very similar to the size of the high yield bond market and the broadly syndicated loan market. So it's basically caught up to the two other big markets since then and continues to grow.
You'd mentioned, the access portion has largely been solved. Can you talk a little bit about that and the evolution of access? And then I'd like to go back to the future state that you see, the customization and kind of what that means.
Yeah, well, maybe I'll walk back my comment before. I don't think it's 100%. I don't think it's 100% solved, but I think we're a lot further along than we were when I started in this industry, which was maybe around 2005. But I also think the access is a little bit asset class specific. What I've seen in terms of what the average sort of high net worth investor has access to has primarily been in two sectors. And even two subsectors, I'd say, within those sectors. So I'd say private credit has been one, and particularly within private credit, something that's called unitranche senior secured lending, which is basically writing big loans to private companies. And then within real estate, core real estate, and across sectors. And what drove that initially, what really has driven this market for a long period of time, and it's changing right now, is demand for income. So you think about what the broader market was doing, as we talked about a little earlier, which is we're in this extremely low interest rate environment. People had income needs, and traditional sources of income were generating very, very little yield. What you saw is a bunch of these alternatives come and say, hey, we can give you call it a 6 to 8% current yield on a private asset that's going to be very stable over time. And that was very desirable, right? You're getting, 600 basis points of additional yield. Yes, you're taking a little bit of liquidity out of your portfolio, but people saw that as a good trade because a lot of people were retiring, needed income from their portfolio, and that was a big driver. Now, with interest rates going back up, the relative value of giving up your liquidity becomes higher, right? Like if you can get 6 or 7% from high yield bond fund or probably that you can trade in and out of every day, you got to think a little harder about, do I really want to be in a less liquid asset that's maybe going to give me an extra 100 basis points or 200 basis points? The sort of access to those sectors is out there, and those are still interesting sectors, and there's still managers doing a lot of interesting stuff in there. So I'm not saying that folks shouldn't look at those. Other parts of the industry, I'd say, particularly in private equity and venture, still those still remain harder to access. I'd say for the same reasons people were interested in the income portion, people were less interested in the equity portion, right? Because equity markets were doing pretty well, and do people want to make the trade-off to go into private equity or venture to make, even though those markets could outperform, maybe the relative outperformance wasn't worth the liquidity trade-off. Well, now we're seeing that sort of turn on its head a little bit, where people think the outlook for public markets is not so great. Private markets get more interesting. So I think what you're going to see is more of those sectors come to light and come to access. I think some of them are a little harder in terms of some of these packages we talked about, like the BDC is one package, an interval fund is another package. So I think people are still figuring out some of the right packaging to thread that needle of having a private asset in a quasi-liquid vehicle. But that's coming. That you're going to continue to see that to grow. But because that's coming, because there are more and more options, and not everybody is an expert in private markets, and they're much harder to navigate. There's not as much data. When you have 3 to 5 choices, even if you're not an expert, you can probably get your arms around the pros and cons of those 3 to 5 choices. when you start having, hundreds of choices that all sound kind of similar from managers, maybe some some you don't know, then it becomes a lot harder. And I think that's where, we're trying to step in and provide a technology-based solution that makes it easier for folks to analyze these different private market options and say, okay, I like the sound of this, but is this really for me in my portfolio? Is there a better option that fits me better, rather than just, I'm so excited to get into private credit, I'm going to go with the first manager I see. Now people are hearing from a lot more folks and want to spend more time analyzing. And I think that we're going to continue to see that evolve over the next decade.
What do you think of the SEC's proposal last year in 2022, a private fund investor protection proposal? Do you think that'll go a step towards providing better information for investors, or is that going to raise the cost for investors? Do you have a take on that?
Yeah, probably all of the above. I mean, so you got the disclaimer first. So I am still a licensed attorney, but not a practicing attorney. But I definitely follow the SEC's proposals and sort of regs in the industry more broadly, because it's been that is also a big driver in this industry is the regulatory landscape. I think when I saw that proposal, and when I think about the broader sort of long-term landscape of how this industry is being regulated, a few years ago, the DOL came out with a proposal to protect investors that had to do with how financial advisors interacted with their investors and how they disclose things to their investors. Now, what's interesting about that, and why it kind of relates to what you're talking about, is there's sort of two regimes within the law of how advisors and investors interact. And so advisors can be advisors to funds, right? If you're registered investment advisors under the Advisors Act can be advisors to funds. They also, the RIAs that individual investors are regulated under the same set of regulations. That's the Advisor Act. There's another set of regulations, the broker-dealer regulations, that there's a SRO called FINRA, a self-regulatory organization. It's effectively like a subsidiary of the SEC, right? So the two ways that funds or individuals can interact with these intermediaries are, in the broker-dealer world, generally you're under a suitability regime, which means that if you're a broker-dealer and you make a recommendation to a client, it has to be suitable. Generally, broker-dealers get paid transaction-based compensation, so they're paid a commission. Then there's the registered investment advisor regime. That regime is held to a fiduciary standard, which is basically the highest standard under the law. You have a duty of loyalty and a duty of care. Generally, the arrangement between registered investment advisors and clients, whether they're funds or individuals, is an annual ongoing fee, right? It's either a wrap fee or an asset management fee, like the old 2 and 20, like the 2 is the management fee, right? So you have these two regimes. And so under the DOL rule, the regulators were really pushing people towards this fiduciary regime, right? They were saying that the commission-based stuff was rife with conflicts. You need to go under this fiduciary regime. Now, under the thing is, under the fiduciary regime, there are basically no additional rules, right? It basically says you need to interact as a fiduciary, so you just need to treat people well. Under the broker-dealer regime, there's this huge set of rules that broker-dealers have to abide by that FINRA and the SEC have promulgated. That has to do with all different types of things. So you have the commission-based regime, which has tons of rules and regs, and then you have the RA regime, which basically doesn't have any. And the regulators are pushing towards the RA regime because they said the fiduciary standard's better. I'm finally getting to what you're talking about. Now what's happening, right, is you have this fiduciary standard. Well, the SEC doesn't have the staffing to actually enforce and actually monitor investment advisors. They're understaffed. FINRA has a massive staff to look at the broker-dealers. So now what's happening? The RIA regime is starting to look more like the broker-dealer regime. Now they're promulgating rules that are basically saying, yeah, you're fiduciaries, but we're not going to give you the freedom of contract on certain things. We're going to make sure, even though you're fiduciaries, we're going to tell you what you have to do as a fiduciary. Not only that, what's even more interesting about this one is they're not only looking at the registered investment advisors, they're also telling what unregistered investment advisors to do. So what that means is the industry has basically structured itself. If you think about most of the private market industry has structured itself to avoid regulation. They structure their funds and they structure their interactions to avoid regulation. And now what the SEC is saying is, even though you followed all the rules to avoid regulation, we're still going to try to regulate you, right? So it's a really funky way that they're approaching it. I can see why the industry pushes back. I mean, they're trying to, most of the time the SEC is trying to protect the smaller investor from getting taken advantage of. But by hitting the unregistered advisors, they're really getting in between like institutions and funds. And a lot of the institutions have even pushed back and said, we've negotiated these structures. We're aware of them. Like, we don't really need this help. So it's an interesting dynamic. I do think, there's some things in there that could be really helpful. There's some things in there that I think it'll, more regulation will always increase costs. So you just got to balance that. So that's a very long answer.
No, it was fantastic though. I mean, they've had other proposals, other laws passed, whatever, that has loosened the requirements for, like, say, an accredited investor, I think, if I'm using the terms correctly. So they've opened it up to a few more people that can access some of these private investments.
That's
so I
true.
guess maybe they're trying to back up a little bit and provide a little bit more protection overall. But
the accredited investor loosening is probably a smart thing. I mean, all the definitions on there's the accredited investor or qualified person. They're all based on net worth, and they basically use net worth or income as a proxy for sophistication. So they're basically saying, look, if you have $1 million, you must be sophisticated. So then you need less protection. If you have $5 million, you're even more sophisticated, even less protection. And then some people are saying, well, wait, hold on. Like, I've worked in finance for 20 years and, I structure these deals, but I can't invest in them because I don't have enough money. Like, how does that make sense? So yeah, I do think that, expanding those definitions to allow, to be thoughtful about, yes, we need to protect people maybe a little more that are unsophisticated, but maybe dollar amount of net worth isn't the only measure we should use to figure out who needs more protection.
Yeah, nor is it a measure of sophistication, actually.
That's right.
But,
if you inherit $5 million and you've never worked a day in your life, you'd still be qualified to invest in some of these things. So yeah, it was a shortcut, I think.
Yeah.
Mm-hmm.
When you think about who private investments are right for, and maybe to help advisors and individual investors who are listening to this think about this for their own portfolios, who is it right for and who is it not right for? How do you think about that?
Yeah. So I think the way we think about it, and I think the way everybody should think about it, is that, of course, not every investment is right for every person. And I think the way most financial advisors approach their clients is that they talk to their clients about their clients' long-term goals, what their concerns are, what their risk tolerance is, what liquidity needs they have. And they try to develop a long-term plan to help them execute that. We think that, and I think more and more people are thinking that some allocation to private markets should be a part of that, because private markets can offer diversification, they can offer additional income, they can offer growth, depending on what part of the private markets you access. If you need 100% liquidity, tomorrow, and you have a short time horizon, you should probably avoid locking up capital. It's probably not for you. I'd say that's a very, very small part of the investing market. I'd say most people who have a decent size investing portfolio can probably afford to lock up some portion of it, assuming that giving up that liquidity offers them some additional return. So then the question becomes, how do you size that appropriately, right? Is it appropriate for me to do 5% of my portfolio liquid, 10, 20, 50? That's where, that's the customization part that I'm talking about. That's the individualization part I'm talking about. It's not only which funds, which vehicles, which strategies, but also like how much of my portfolio should be in that, and should that change over time? You have target date funds, right, that do that for you in public markets. You invest in the 2060 target date fund, it's like 100% equities now, and then by the time you get to 2055, it's going to be like 30% equities because you need to adjust that allocation over time. In private markets, that's a little more complicated because you can't get liquidity all the time. There's different so that's where I think, advisors, individuals really need help. That's, what we're building here at Opto, and that's not something that I just decided was important. After I came to Opto because, I've seen this market grow over time, and I think this is where it's going. And so, you talk a lot about trends on your podcast. This is a trend, I'm betting my career on. So, I hope I'm right, but I think that is the trend, and that's where folks are going to need help and more tools to do that in a smart, individualized way.
Are you seeing other areas with less activity? I mean, I read an article in the Wall Street Journal about venture activity had fallen off a bit. And are you seeing that as well?
Yeah, I mean, it depends on what you mean by activity. But yeah, I mean, I think I saw that article that venture capital raising has come down, which I think is understandable. I think, the drivers there are a few things. One, a lot of VC managers, when we were in the heat of the bubble, let's say, of tech IPOs and liquidity events within VC, right? So if you think about all these big tech IPOs, that means that liquidity is coming back to VC investors. A lot of VCs came back to market during that time. VCs go on a fundraising cycle of 3 years-ish, right? So they come to market, they raise a fund, and then they leave the market and invest and come back to market cyclically. A lot of VCs, there was liquidity that came into the market. They came back to market. They raised money while the market was hot, and maybe even off cycle a little bit for them because they knew the market was hot. There was liquidity events. People wanted to roll their money back in. So a lot of that activity was happening, call it, 2021, maybe in early 2022. And now that we've seen that sort of fall down a little bit because of that, we've also seen, from the institutional side, this idea of the denominator effect, which is that, as institutions have a target allocation to privates. Well, when your value of your public book goes down by 20%, now all of a sudden your allocation to privates looks a lot bigger, right? Because the public piece is smaller. So now they can't redeploy into privates because they have this denominator effect. They're supposed to be at 20% alts. Now all of a sudden they're at 30 because the rest of their book went down and the alts stayed pretty flat. The other interesting little dynamic, I'd say, is that we've seen that the bigger managers continue to be able to raise money. So what's happened is when you've seen the capital raise go down, it's really those like emerging managers. People were willing to take a little bit more risk on emerging managers when times were hot. But now that times are, people are feeling a little more constrained, people are a little more risk averse, the allocation to emerging managers has gone down. So if you think about the overall market, the fund count from 2021 to 2022 went from 2,500 to 1,400, not quite cut in half, but almost. But the established managers hit a capital raise record. So the established managers were still doing fine, but the emerging managers that people viewed as a little more risky were not. But I think ultimately, venture, we think, or particularly early stage venture, is in a good place because there's dry powder. There's something like 600 billion dry powder. There's a ton of dry powder. That's a lot of new companies that can be started. And generally, like in a falling valuation environment, if you're smart, like you can't time the markets, but we know valuations are going down. And if venture funds are putting out money over the next 3 years in sort of a lower valuation environment, that should bode well for, if you're a 10-year fund. Yeah, a lot of interesting dynamics happening right now.
What kind of companies do you think will see more interest from venture, if you will? Types of industries, types of technologies, anything kind of standing out? Like, AI, money's going to be going to AI or something like that.
Yeah, I mean, for sure. The generative AI activity has, it's now entered the sort of broader zeitgeist, right? But the venture was early to that. Generative AI investment went up 5x in 2021. So from 200 million to over $1 billion. We saw, the CHIPS Act, which should help drive investment into these types of things. I think energy transition continues to be a big theme that we see. Intermittent renewables like solar and wind, 14% compound annual growth rate. Grid infrastructure is this is like battery storage. So that drives a lot of things. that's predicted to have a 50% compound annual growth rate over sort of the medium term. We saw a huge deal get done in the fusion space, right? There's been some innovations coming through in fusion. Implementation of nuclear fusion is still quite a ways out, but I think that's another one that's starting to sort of enter the broader public and people getting more interested. So everything around energy transition and clean energy, and then you have the Inflation Reduction Act, which pushed a lot of incentives to energy transition. That's expected to drive $3 trillion worth of investment in the coming years. So I think those broader themes are definitely getting hit in the VC community.
That's great. Yeah, we talk a lot about those themes too, largely on our public ETF side, but interesting to see that there's that kind of activity also in the private markets or private companies as well. As far as RIAs that might be interested in working with Opto, how do they? What's the best way of working with you guys, or do they reach out? And is there another way of teaming up with you?
Yeah, absolutely. I mean, we have a whole, even though we're tech first, we do have humans here. So we have a whole team that's focused on solutions for RIAs. We have a website, as you expect us to, optoinvest.com. But we have a whole team built around that, helping people understand our approach, how the tech works. And then as we continue to evolve and build more tech, implementing that and making sure that the one thing that's critical to us is we know that RIAs have a lot going on and they have a lot of different pieces of technology that they use for different things. And we're very focused on integration, right? We're not asking for clients to trash everything they built and just use Opto. We are looking to be a plug and play solution specifically for private markets execution. So that should be really easy to integrate with the rest of the existing tech stack.
With the few minutes we have left, I'd like to typically close out the podcast a couple different ways. The first of which, we've already talked about a lot of trends, but I'll give you another opportunity, is to ask you, what's one long-term trend you see playing out over the next several years?
I guess I would say, of course, I think this is me personally. I think there's going to be continued drive towards individuals participating in this market. But I think there's going to be just increased visibility around various different subsectors as this market matures. You look at, take the real estate market, for example. When I started working this, you basically had office, you had retail, you had multifamily, and hospitality. You had like 4 institutionally investable areas. Now you've got industrial. Then you got things like single family rentals. You've got things like self-storage. You've got all these new sectors popping up that are becoming investable asset classes. I think you're going to continue to see that across all these sleeves. I think you're going to see within private credit, it was broadly middle market lending. Well, you're going to see a lot of differentiation. You're going to start to see people understand the difference between sponsored deals and non-sponsored deals, which means that deals where private equity folks own the equity versus deals where private, you're going to start to see this increased interest in subsectors within all these private sectors that are going to create new opportunities. It's going to, people are going to have to continue. It's a constant educational process, and it's going to allow people to really get very specific exposure. You're going to see more and more specialists pop up. So I think that's going to be a big trend, as people get smarter and these sectors continue to grow, as you're going to have subsectors rise and then become institutionalized. It's going to be really interesting to see which ones survive and which ones don't. And the second way I end off is with our speed round called Trend or Fad. Okay. You willing to play that? Yeah, let's go. Let's see how this goes. All right. So I'm going to ask you about 3 to 5 different topics, get your quick take. Let's start out with hydrogen. Trend or fad? Trend. Venture rounds greater than 100 million. Trend or fad? Oof. I think it'll be a trend, but not right now. But it is long-term trend. Long-term trend. The creator economy. Trend or fad? Oh, I think that's definitely a trend. I don't think that's going away. Yellowstone TV. Do you watch Yellowstone? No, I don't. No. All right. I'll fad that one. There was an article about in the Wall Street Journal about how more men are dressing with cowboy hats and boots because of Yellowstone. It's a great TV show if you haven't seen it, but I'm just wondering about that, the influence that has on our pop culture. I will check it out. I'm not against cowboy boots. but I haven't gone the cowboy hat route yet. But maybe I should experiment.
Well, that was awesome. Thank you very much for spending time with me and talking about private markets, Matt.
Thanks so much, Ed. Thanks for being patient with me and let me try to bring you as much information as I can.
Oh, no, it was fantastic. It was really well spoken and really good background. So I appreciate that. And again, the website for Opto, optoinvest.com. Is that right?
That's right.
Awesome. Yeah, definitely check them out. And we'll continue to watch the private markets as well. And so with that, we'll close out. Thank you very much. And thank you for tuning in to another episode of Trends with Benefits.